You know, in 2026, something really strange and frankly kind of brutal is happening on the stock market. Firing thousands of people is now being seen as the absolute clearest signal of a company's bright future. So today, we're going to break down how this whole AI-driven efficiency narrative is totally reshaping things, and we'll separate the real strategic plays from the dangerous speculative traps. Okay, let's dive right in.
So it all kind of boils down to this one simple idea, this new mantra in Silicon Valley, most famously pushed by Block's Jack Dorsey. It's the core belief that's driving this huge transformation. The idea is that a small, super efficient team armed with powerful AI tools can churn out 10 times the work of a huge, old-school workforce. And look, this isn't just some fluffy mission statement. It's a direct challenge to the very idea of what a big, successful company even looks like anymore.
And that really brings us to the big question of this entire explainer, right? Are we actually witnessing a genuine leap forward in human productivity? I mean, like a new industrial revolution, but powered by AI? Or is AI efficiency just a really convenient, high-tech excuse for companies to slash costs and maybe hide some other problems like slowing growth or even years of bad management? That's what we're here to figure out.
Okay, so first up, we have to understand the powerful argument for this new playbook, because there is a really compelling case being made on Wall Street that AI isn't just about cool chatbots, it's about completely re-architecting the modern corporation for maximum output with the least amount of friction possible.
And this leads us to a new term that's basically taken over the market's imagination in 2026: macro efficiency. This isn't just another buzzword. It's a powerful story where, by cutting thousands of jobs, a company isn't just saving money on salaries. No, it's proving its commitment to a leaner, smarter, AI-powered future. And investors, they're eating it up. They're rewarding this story with higher stock prices because they believe these companies are gaining some serious operational leverage.
But here's the thing, not everyone's running this playbook the same way. It's not one size fits all. Let's just look at two of the biggest examples. On one hand, you have Block. Their goal is a radical flattening of the company itself. Then, on the other hand, you have a monster like Meta, who's basically using layoffs as a way to pay for its massive investment in AI hardware. So, two very different paths to the exact same goal, a leaner, more efficient company.
Jack Dorsey's vision over at Block is, well, it's by far the most aggressive version of this we've seen. He's not just trimming the fat, he's trying to build what he calls a mini AGI company. The plan is to cut 4,000 jobs. That's 40% of the entire workforce, and replace all the traditional layers of management with essential AI that every single employee can just query directly. The goal? A shockingly flat organization and a 160% jump in productivity per person. It is a huge gamble on a totally new way of working.
So, the whole point boils down to this number: $2 million. This is Block's target for gross profit per employee by the end of 2026. Now, just to put that in perspective, they were at $1 million in 2025. They are literally aiming for a 100% year-over-year increase in efficiency. This is the alpha. This is the tangible number that has investors so excited about this radical new strategy.
Now, let's contrast that with Meta. Their approach is less philosophical and, honestly, more brutally pragmatic. They're on track to spend an absolutely eye-watering $135 billion on AI infrastructure in 2026. So, to help pay that massive AI bill, they're cutting 10 to 20% of their staff. What Meta's doing really shows this new calculus perfectly. They're making this move from a position of incredible financial strength, essentially trading human capital for silicon capital.
But, for every Block or Meta that has a clear, even if it's controversial, strategy, there's a much darker side to this whole trend. This is where the AI narrative gets hijacked by companies that aren't really innovating at all. They're just desperate. And we're calling this AI washing.
And the poster child for this whole epidemic is a company you might know for its comfy wool shoes, Allbirds. The story of Allbirds' pivot to AI is a really stark warning about what happens when the market just gets obsessed with a story, rewarding the narrative way more than any underlying reality.
I mean, just look at this pattern. It's undeniable. Allbirds, a sustainable shoe company, announces it's pivoting to GPU as a service, basically renting out computer power for AI, and its stock shoots up 582% in a single day. You see the exact same thing with Mycelium, an encrypted messaging app, and Mantra, a legacy crypto token. These are struggling companies in totally unrelated fields that are just slapping an AI label on themselves and getting rewarded with these huge speculative stock surges.
So what's actually going on here? Well, it's a pretty cynical game, and it's called exit liquidity.
See, the sudden hype from an AI announcement brings in a flood of everyday investors who have a major fear of missing out on the next big thing. Their buy orders create this huge wave of cash, that's the liquidity, that allows the original insiders and early investors to sell their shares for a massive profit, leaving all the new people holding the bag when it all comes crashing down.
And this whole thing happens incredibly fast. It's like a predictable 72-hour trap. In the first few hours, trading bots pick up keywords like AI or GPU in a press release and just automatically start buying, causing that initial price spike. Then the story hits social media, and that retail FOMO kicks in hard. Over the next day or two, the insiders cash out. And by the 72-hour mark, the party's over. The volume dries up, and the stock completely craters, leaving a trail of destruction behind it.
So this brings up the obvious question, right? How in the world are you supposed to tell the difference? How do you separate a genuine strategic pivot from just a desperate last-ditch rebranding effort that's only designed to create that exit liquidity? Well, the difference often comes down to one single factor: scale. Okay, so on the left, you've got the zombie pivot of Allbirds. They sold off their core shoe business for just $39 million and then got a $50 million loan, often through sketchy debt structures like convertible notes, which is a huge red flag because it lets early investors cash out super fast. Then, on the right, you have a real strategic pivot from a company like Oracle. They're funding a 50 times billion-dollar data center expansion by cutting 30,000 jobs. The difference isn't just a few zeros. It's the difference between playing a game and building an empire.
And this slide really just drives the point home. To truly compete in the AI arms race, you have to be spending at the level of the hyperscalers, Amazon, Microsoft, Google, who are dropping over $100 billion a year on this stuff. In that context, Allbirds' $50 million investment isn't just small, it's literally a rounding error. It's a clear signal that this is just a story they're telling, not a serious business venture.
Okay, so with all this chaos, real innovation on one side, cynical rebranding on the other, investors need a new toolkit. We need a way to cut through all the marketing hype and actually analyze what's happening inside these companies. And really, if there's one number you need to watch in this new era, it's revenue per employee, or RPE. It's a beautifully simple number. It just tells you how much revenue the company is generating for every single person on its payroll. In the age of AI, this has become the ultimate measure of efficiency and operational leverage.
So when we actually put this metric to work and benchmark the big players, the picture gets really interesting. You can see the pivoters like Meta and Block are generating incredible value per employee. Meta is at over $2.5 million per person. They're right up there with the established hyperscalers like Alphabet and Microsoft. This data shows that when it's done for strategic reasons, this radical restructuring can create immense efficiency that you can actually see in the numbers.
So here it is, an actionable checklist you can use. First, check the hiring. Are they bringing on top-tier machine learning engineers, or did the CEO just add AI to their bio on X? Second, what are they actually building? Is it a real infrastructure play, or are they just putting a pretty user interface on top of someone else's API? Third, look at their old business. Do they sell everything off, like Allbirds, or are they integrating AI into their core business? And finally, check the financing. If you see it's funded by that convertible debt we talked about, that is a huge red flag for a quick insider exit.
Okay, last thing. We've got to talk about some of the brutal truths behind this entire trend. Because even when the efficiency story is real, there are some major risks and nuances that most investors just completely miss.
Even with a company like Block, which has a legit strategy, you've got to look at their history for a reality check. Historically, Block has been way less efficient than its competitors. For every dollar of gross profit, Block has only kept 16 cents as operating income. Compare that to 41 cents at PayPal and 53 cents at Adyen. This kind of suggests that the massive layoffs might be just as much about fixing years of operational bloat as they are about pioneering some new AI future.
And this might be the most brutal truth of all for the average person watching the market. You see the headlines about massive layoffs, a bold new AI strategy, the stock is soaring. When do you buy? The reality is, by the time you hear about it, you're almost certainly too late. The market is so fast at pricing these stories in that the huge gains, like Block's 20% after-hours jump, they happen instantly. The real upside is often gone before the market even opens the next day.
So we end up right back where we started, facing the central dilemma of 2026. In a market that has just fallen completely in love with the story of efficiency, where leaner is always seen as better, the ultimate challenge is to separate fact from fiction. How do you, as an investor or even just an observer, tell the difference between a true productivity miracle and a failing company that's just putting on an AI disguise? That really is the billion-dollar question.